Here's how to find silver below spot price. Right now, while most investors are chasing headlines, a quiet window is open, one that lets ordinary people acquire real silver for less than its market value. But this window is not permanent. It exists because of cracks forming underneath the surface of the precious metals market. Cracks that most people watching this video have never been told about. Dealers know it, institutions know it, and in the next few minutes you will know it too. Because what we are about to reveal is not a shopping tip. It is a warning disguised as an opportunity, and by the end of this video, you will understand exactly why silver below spot price will not stay available for long. Welcome to Currency Arc Insight, the channel where we break down the economic signals hiding in plain sight. If this kind of strategic analysis matters to you, consider subscribing so you never miss a briefing. And before we continue, let us know in the comments which city or country you're watching from today. Most investors believe silver has one true price at any given moment. They watch the spot price update on their screens and assume that number represents what silver actually costs to buy. This belief feels logical, it feels safe, but it is incomplete, and that incompleteness is exactly where opportunity and risk both begin. The spot price is not a price at which anyone can walk into a shop and buy silver. It is a benchmark. It reflects the value of silver traded in large volumes on global futures markets, far removed from the counter of a local coin shop or the inventory of a small bullion dealer. Between that benchmark and the real physical market where individuals actually buy and sell silver, there is a gap. And inside that gap, prices move in ways the average person never expects. Some dealers sell silver above spot price to cover their costs and secure profit. This is well understood and rarely questioned. What surprises most people is the opposite. Silver can and does sell below spot price. Not occasionally, not as a rare accident. It happens consistently in specific corners of the market, for reasons that have little to do with generosity and everything to do with pressure. To understand why, one must abandon the idea that silver trades in a single unified marketplace. It does not. It moves through a patchwork of local coin shops, regional dealers, online platforms, and private collectors, each operating under different constraints. A coin shop in one town may be sitting on old inventory it needs to move quickly. A dealer overseas may be facing currency pressure that makes offloading silver at a discount more attractive than holding it. A private seller may need cash immediately and have no patience for negotiating a premium. Each of these situations creates a small crack in the price structure. On their own, these cracks look like isolated bargains. Lucky finds, stories people share with pride after visiting their local coin shop. But when examined together, across thousands of transactions happening simultaneously around the world, they reveal something larger. They reveal a market under quiet strain, one where liquidity, not scarcity, is often the real force setting prices at the street level. This is the first signal serious investors must learn to recognize. When physical silver becomes available below spot price in noticeable volume, it rarely means silver has become less valuable. It usually means something else entirely. It means holders of physical silver, whether individuals, dealers, or smaller institutions, are under pressure to convert metal into cash faster than the broader market is willing to reward them for it. This is not speculation. It is a pattern that has repeated across decades of precious metals history. Periods of below-spot availability have consistently appeared during moments of economic uncertainty, when confidence in paper assets wavers and physical holders reassess their priorities. What looks like a discount to the casual buyer often functions as an early warning sign to those paying closer attention. For the average person scrolling through social media, this looks like nothing more than a helpful tip. Find your local coin shop, build a relationship, wait for good deals. And on the surface, that advice is not wrong. But beneath it lies a much larger economic story, one that connects a single transaction at a small-town coin counter to shifts happening across the global silver supply chain. Understanding this connection changes everything. It transforms a simple bargain hunt into a piece of a much bigger puzzle, one that reveals how fragile, fragmented, and reactive the physical silver market truly is beneath its calm exterior. What comes next reveals exactly where these discounts originate and why the very forces creating them today are the same forces that could make them disappear without warning. Understanding why below-spot silver exists is only half the picture. The other half, the part that actually matters for outcomes, is knowing how a serious investor should respond while this window is still open. Analysis without action is simply commentary. What follows is not commentary. It is a framework for positioning. The first principle is patience treated as a competitive advantage. Casual buyers want silver immediately, and they are willing to pay whatever the market asks to get it. Serious investors behave differently. They understand that the best opportunities in physical silver rarely arrive on demand. They arrive through consistency, through showing up repeatedly at the same local coin shops, through building familiarity with the same dealers over months and years. This patience is not passive waiting. It is active positioning, placing oneself in the path of opportunity long before that opportunity becomes visible to everyone else. The second principle is relationship-based sourcing. As explained earlier, dealers do not offer their best discounts to strangers. They offer them to buyers they trust, buyers who have proven themselves reliable, respectful, and consistent over time. This means the smartest move an investor can make right now is not simply searching for the lowest price online. It is investing time in local relationships, visiting shops regularly, asking questions, and becoming the kind of customer a dealer thinks of first when new inventory arrives. In a market where discounts are distributed through trust rather than advertising, relationships function as a form of capital in their own right. The third principle is recognizing the difference between opportunity and entitlement. Many investors fall into a dangerous assumption once they experience a few successful below-spot purchases. They begin to believe this access will always exist, that the market owes them a continuous stream of discounted silver simply because it has appeared before. This assumption is precisely the complacency that Part 3 warned against. The forces tightening supply do not pause for individual expectations. A buyer who assumes yesterday's conditions will repeat indefinitely is a buyer who will be caught unprepared when the window narrows. The fourth principle involves timing discipline. Serious investors do not attempt to predict the exact moment below spot silver disappears. That level of precision is neither realistic nor necessary. Instead, they treat the current environment as a limited time condition and act accordingly, acquiring physical silver steadily rather than waiting for a perfect moment that may never arrive. This approach protects against the regret of hesitation, a regret shared by countless investors throughout history who watched opportunities close while waiting for confirmation that never came. The fifth and final principle ties everything together. Below spot silver is not simply a shopping tactic. It is a small, accessible entry point into a much larger economic story, one involving industrial demand, constrained minting capacity, and institutional accumulation happening on a scale most individuals never witnessed directly. Every discounted coin acquired today represents a small hedge against a future in which such access may be significantly harder to find. Viewed this way, the current window is not just an opportunity to save money. It is an opportunity to build a position before broader market forces make that position more expensive to establish. This is the core message beneath everything discussed across this analysis. The below spot silver market functions as a quiet signal, one that reveals liquidity pressure, structural imbalance, and shifting supply dynamics long before those forces become visible in headlines or mainstream financial coverage. Investors who recognize this signal early, who act with patience, discipline, and strategic relationship building, position themselves ahead of a curve that most people will only notice after it has already moved. The window remains open for now. How long it stays that way depends on forces already in motion, forces described throughout this analysis. What happens next depends entirely on whether those watching choose to act while the opportunity still exists, or wait until it has quietly closed without warning. Every below-spot silver deal has a story behind it, and almost none of those stories begin with generosity. They begin with pressure. To understand where these discounts truly come from, one must look past the shop counter and into the circumstances that push silver into circulation faster than the broader market would naturally demand. The first and most common source is aging inventory. Coin shops and small dealers often hold silver that has sat unsold for months, sometimes years. Constitutional silver coins, older proof sets, and worn bullion pieces fall into this category. These items are not undesirable, but they are not always in high demand either. A shop owner sitting on a drawer full of this inventory faces a simple business reality. Capital tied up in unsold metal is capital that cannot be used elsewhere. Rather than wait indefinitely for a buyer willing to pay full premium, many dealers choose to move that inventory at or below spot price, accepting a smaller margin in exchange for freeing up cash flow. What looks like a lucky find for the buyer is, from the dealer's side, a calculated decision about liquidity. The second source is forced liquidation. This happens when an individual seller needs money quickly and has no interest in negotiating for top value. Someone facing an unexpected expense, a sudden life change, or simple financial strain will often sell silver to the first buyer willing to pay in cash, even if that price sits below what the metal is technically worth. Dealers who buy from these sellers frequently pass a portion of that discount along to their own customers, particularly loyal ones. This is why relationships matter so much in the physical silver market. A dealer who trusts a regular customer is far more likely to offer that customer first access to a discounted batch of coins before the news of the deal ever reaches a wider audience. The third source is less obvious but arguably more important. It involves regional and structural imbalances in supply. Not every part of the world experiences silver demand equally. A region with fewer active buyers, weaker local currency conditions, or limited access to major bullion markets may see silver accumulate locally without enough demand to absorb it at full price. In these pockets, silver can trade meaningfully below spot simply because there are not enough buyers competing for it. This is not a sign of abundance in the global market. It is a sign of temporary disconnection between local supply and local demand, a gap that tends to close once broader market attention shifts toward that region. Taken individually, each of these sources seems small, almost anecdotal. A shop clearing old stock, a seller in need of quick cash, a quiet region with soft demand. But taken together, they form a pattern that reveals something important about the physical silver market. Discounts do not appear because silver has lost value. They appear because someone, somewhere, is under pressure to convert metal into cash faster than the market is rewarding them for it. This distinction matters enormously for anyone paying attention. A buyer who understands this pattern is not simply hunting for bargains. They are reading a signal about where liquidity stress is concentrated at any given moment. Today, it may be a small coin shop clearing inventory. Tomorrow, it could be a broader regional imbalance tied to currency weakness or economic uncertainty. The mechanism is the same, even as the scale changes. This is why serious buyers do not treat below spot silver as luck. They treat it as information. Every discounted coin passing across a counter carries a small piece of a much larger economic story, one shaped by liquidity, urgency, and the quiet pressures most casual investors never see. What remains to be understood is how long these conditions can last, and why the very forces creating these discounts today are the same forces capable of shutting the window closed without warning. Every discount has a shelf life, and the below spot silver window is no exception. What feels like a steady, reliable source of cheap silver today rests on a foundation that is shifting beneath the surface, often faster than the average buyer realizes. To understand why this window will not stay open indefinitely, one must look at the forces working against it from multiple directions at once. The first pressure comes from industrial demand. Silver is not simply a store of value. It is a critical input in electronics, solar technology, and a growing list of advanced manufacturing processes. As industries expand their reliance on silver, more of the metal is consumed permanently, removed from circulation rather than recycled back into the investment market. This steady industrial appetite competes directly with the same physical supply that coin shops and dealers rely on to build the inventory eventually sold at a discount. When industrial buyers absorb more silver, less remains available to trickle down into the smaller transactions that create below-spot opportunities. The second pressure comes from mint and production constraints. Coins and bullion products do not appear instantly. They depend on refining capacity, minting schedules, and supply chains that can tighten quickly under stress. When demand for physical silver rises sharply, whether from retail investors or larger institutional buyers, mints often struggle to keep pace. This creates bottlenecks upstream, and those bottlenecks eventually reach the local dealer level. A shop that once had steady access to aging inventory or overflow stock may suddenly find that supply drying up, not because interest in silver has faded, but because the entire pipeline feeding that supply has become more constrained. The third and perhaps most significant pressure comes from institutional behavior. Larger players, including funds, refiners, and even some governments, do not operate on the same timeline as individual buyers. When these institutions sense tightening supply or rising long-term value in silver, they begin securing physical metal in larger volumes, sometimes quietly, sometimes visibly. This kind of accumulation pulls meaningful quantities of silver out of the broader pool that eventually filters down to local markets. As institutional stockpiling increases, the small cracks in the market that once allowed below-spot deals to exist begin to close, simply because the metal that once flowed loosely through smaller channels is being absorbed higher up the chain. Taken together, these three forces reveal an uncomfortable truth. The very conditions that created today's below-spot opportunities are lagging effects of a market that has not yet fully adjusted to tightening supply. Aging inventory eventually gets sold. Forced liquidations are, by nature, temporary events tied to individual circumstances rather than a permanent feature of the market. Regional imbalances correct themselves once broader attention and demand catch up. None of these sources of discount are designed to last indefinitely. They exist because the market has not yet caught up to underlying pressure, not because that pressure has disappeared. This is the part most casual buyers overlook. They see a good deal and assume similar deals will always be available somewhere if they simply keep looking. But the structural forces described here suggest otherwise. As industrial consumption rises, as minting capacity struggles to keep pace, and as larger institutions continue positioning themselves ahead of retail investors, the pool of silver available for below-spot transactions will shrink. What is common today may become rare within a relatively short period of time. For those paying close attention, this is not a reason for panic. It is a reason for urgency grounded in analysis rather than emotion. Recognizing that a window is closing changes how one behaves while it remains open, It shifts the mindset from casual bargain hunting to strategic positioning, from assuming abundance to acting on the understanding that scarcity is approaching from multiple directions simultaneously. What follows is the most important part of this analysis, the strategic response serious investors must consider before this window narrows further, and why complacency at this stage carries a cost far greater than most people realize.